Charles W. Mulford, The Financial Numbers Game, Detecting Creative Accounting Practices. Dive into the eye-opening world of creative accounting practices and their impact on the economy with The Financial Numbers Game, by Charles W. Mulford. The book summary delves into 6 significant causes, consequences, and cures that shaped the financial crisis, exploring the intricate relationship between capitalism, business cycles, and government policies. Gain a deeper understanding of how the Federal Reserve, U.S. Treasury Department, and federal agencies contributed to the 2008 crisis, the role of housing and banking sectors, and the importance of adopting a free market capitalist approach to prevent future economic disasters. This summary will guide you through the critical topics and themes, unraveling complex notions using an engaging and user-friendly language.
The Untold Causes of the Great Recession. The Great Recession has been widely attributed to Wall Street greed and capitalism. However, the reality is far more complex, and irrational government policies are to be blamed for the financial crisis. The book presents 6 causes, consequences, and cures that are often overlooked in analyzing the crisis. These key factors include the U.S. government's role in the housing industry, the Fed's poorly executed monetary policies, and the exclusion of non-bank financial institutions from regulation. The book sheds light on the root causes of the Great Recession and offers solutions to prevent such crises from happening in the future. Capitalism and the 2008 crisis. Capitalism, with its business cycles of booms and busts, is considered flawed by many due to the government's need to step in and regulate markets. However, the 2008 financial crisis showed that the government itself had a hand in creating the risk that led to the crisis. Contrary to popular belief, deregulation was not the cause of the crisis. Instead, regulatory burdens from major laws, such as the Sarbanes-Oxley Act and the Patriot Act, piled up and added billions of dollars to audit and financial security expenses. Privacy Act disclosure notices also cost hundreds of millions of dollars annually. The financial industry's cost of regulation spiked in the years leading up to the crisis, signaling that government intervention can also lead to distortions in the market. The rise and fall of the American dream. The American dream of homeownership was incentivized by the government through financial enticements and programs that extended loans to minorities. However, the overallocation of capital in the housing market created a bubble. In 2006 and 2007, the new Fed chairman increased the Fed funds rate, ending the dynamic that both Alan Greenspan and stakeholders viewed as a no-lose scenario. The colossal portfolio amassed by the GSEs peaked in 2008, with $2 trillion in subprime mortgages and 1,000-to-1 leverage. The 2008 financial crisis, a result of poor governance and risky behavior. The banking sector plays a critical role in providing capital and liquidity that drive the economy forward. However, misguided policies and risky behavior led to the subprime meltdown, causing a liquidity crisis that triggered the 2008 financial crisis. Financial institutions took in funds from depositors and lent them out to companies, projects, and assets, making profits through leverage. But, too many banks piled enormous debt into their balance sheets, and investment banks' pre-crisis leverage ratios stood at approximately 30-to-1. The Federal Deposit Insurance Corporation, FDIC, was created to protect depositors' funds, but it allowed perils to develop and compromised the health and quality of financial institutions, rewarding risky behavior. The FDIC exercised shoddy governance over the financial industry, cementing the belief that the government would be the last resort rescuer of banks deemed too big to fail. The 2008 crisis was triggered by a complete washout of capital, $500 billion, due to misallocation of capital into residential housing in prior years. Housing prices were 30% higher than people could afford, leading to a subprime meltdown. Stakeholders didn't recognize the potential danger of residential housing assets, treating them as investments instead of consumption. The securities that institutional investors had purchased contained huge amounts of toxic subprime paper with a premium grade seal of approval from the rating agencies. The agency's mathematical models failed, and the damage from the ratings fiasco affected the wider capital markets. Regulators labeled financial firms outside the traditional deposit-based monetary system as shadow banking entities, consisting of hedge funds, insurers, the investment banking community, and more. Unregulated, these firms dealt with innovative derivatives that proliferated based on the assurance of premium grades from rating agencies. Incentives from government regulatory policies encouraged most financial institutions to make the same mistake. The government's role in financial crisis. The book explains how government intervention in the financial market led to the 2008 crisis and why the regulations that followed may cause the next one. The Troubled Asset Relief Program, TARP, bailed out failing banks without addressing their underlying problems, using taxpayers' money to keep them afloat at inflated prices. The author argues that the government's efforts to prop up the financial system hurt healthy banks instead of letting poorly run ones fail. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 added new regulations but did not address the root causes of the crisis or reduce the FDIC insurance levels. The author suggests that by extending subsidies to poorly run firms, the government undermines the incentives for prudent risk-taking and the development of viable institutions. Ultimately, the book raises questions about the government's role in the financial market and the unintended consequences of its actions. Embracing free market capitalism. The book argues that a return to free market capitalism is crucial for America's economic growth. The author highlights how the philosophy guiding policies is as important as addressing economic concerns. Some government officials support socialism and believe that government should provide goods and services like housing and healthcare to its citizens. However, this diverts capital from the productive economy, hindering growth. The author advocates for a philosophy of individual rights that emphasizes personal responsibility and limited government. Only free markets, trade, and choice can enable individuals to pursue their long-term self-interest and achieve mutual benefits. The book also suggests that government interventions into the financial system during the Great Recession did more harm than good by deepening and prolonging the crisis. The author encourages a hands-off approach that allows the market to correct itself and weak firms to fail. By embracing capitalism, America can achieve greater well-being and ensure a prosperous future. Time to embrace limited government. The book argues that the United States needs to shift towards limited government and free market capitalism to prevent a looming economic disaster. Reliance on government stifles individual opportunity and potential. The author recommends abolishing the Fed and reintroducing the gold standard to discipline financial markets. Other reforms include reducing bank capital levels, privatizing Fannie Mae and Freddie Mac, and decreasing political subsidies for social programs. The book stresses the importance of promoting productivity by enacting low marginal tax rates, cutting government spending, controlling the unfunded liabilities of Social Security, Medicare and Medicaid, and promoting global free trade. The author also recommends expanding legal immigration to attract productive and entrepreneurial foreigners. By following these principles, the book argues that the U.S. can reclaim economic vitality and improved living standards.
In conclusion, The Financial Numbers Game sheds light on the complex interplay between capitalism, government policies, and the housing and banking sectors, which led to financial crises. From the overallocation of capital in the housing market to the repercussions of wrongly rated securities, the book emphasizes the importance of free market capitalism and limited government intervention. To prevent future crises, the United States should consider numerous reforms, including privatizing government-sponsored enterprises, increasing bank capital, reducing regulatory costs, and promoting global free trade. Embrace this insightful guide to learn about the practices that shaped our economic landscape and the steps necessary to secure a thriving and sustainable financial future.